Back to the world of banking, and shaking off the financial crisis with a record profit, Bank of Queensland produced its annual results today. Net income rose 27% to $179.6 million, delivered with above-market growth in both lending and deposits. It's been a busy year for BOQ, bedding down 2 acquisitions, a major securitisation issue and plenty of new products in the offing. I spoke to Managing Director David Liddy a short time ago. David Liddy, welcome to Lateline Business.
Thanks, Dickie. Nice to be with you.
Well, you've only just missed the $200 million profit mark. I'm really interested in your net interest margins and what sort of impact the financial crisis has had on them.
A major impact, Dickie. I think for the full year we increased our net interest margin by 4 basis points, but in the last 6 months we declined 10 basis points. Now, a large impact has been obviously the cost of funding, which is still significantly higher than it was certainly pre-GFC. Across all product ranges, and coupled with the cost of wholesale funding has been very, very competitive, and high cost of retail deposits. That's come off a little bit.
And presumably having that extra liquidity as well.
Yeah, well look, we raised about $1.6 billion recently through a securitisation issue, which has helped us maintain a strong liquidity holding, but it's about 17%, which is significantly above where we'd normally be.
Do you see an out-of-cycle interest rise as absolutely crucial? I mean, what would happen if it didn't go ahead?
Well, I wouldn't say it's absolutely crucial, but I think it's inevitable that it'll occur. The cost of funding banks' balance sheets has got no link to the cash rate that the Reserve Bank sets. And all banks' funding costs are significantly higher than they were. A regional banks is significantly higher than a major bank. So it's a double impost to us.
Now, you still have ambitions to get a return on equity of 15%, I think. What are the challenges ahead there?
Oh, definitely. Look, we've undertaken some acquisitions. We've improved our capital. So a couple of things that we've got control on are very important to us. Cost-to-income ratio for our bank, we're 20th the size of the majors, but we're in relative terms about the same in terms of cost-to-income ratios. The big issue for us is definitely going to be NIM, or net interest margin, and that certainly is a headwind, but we think with the mix of businesses that we've now got, we've gone into an insurance business, recent acquisition in St Andrews, we've bought a vendor finance business, we've got ambitions to move much more aggressively into the motor vehicle business. So we're diversifying our revenue, improving our margins and reducing our capital intensity. So I'd hope that will flow through into the next year.
Are you also assuming that life will return in a few years' time to what it was like in that incredible decade before the financial crisis? Because the cost of borrowing was very cheap. Do you believe that will return?
No, I don't. That's a personal opinion. But I think the cost of credit has changed, I think, forever. I think Australian banking system came through this crisis exceptionally well, and you've got to take your hat off to the management of certainly the major banks and all the banks for that matter, and our regulators and the Australian government for the role that they played. But credit was very cheap and it was pretty easy to get, and I think the risk-return ratios were out of kilter. I think they've returned. And I think that'll be the case going forward.
But you can still manage your ambitions, given that we've had this change forever, in your view.
Yeah, look, I think it's certainly made BOQ a stronger company. We completely had to remodel our business and rethink our funding and where we received or got our funding from. So we've come through with a much stronger capital base, a much stronger liquidity base. And a restructured business in terms of our operational efficiency. So in one way, you can't, out of every bad patch there's some good, and I think that's what we've achieved going forward.
You are different from some of the other smaller banks. You've got different strategies, using third-party brokers being one, and now moving from housing lending to look at equipment finance, leasing and even car financing. Presumably this is also going to increase your risk, isn't it?
Oh, look, it's manageable risk, though. They're businesses we understand. The home loan market is still around about 70% of our overall assets under management, and that will always be a core product. So what we've done with the bank is broken it up into, or the group, BOQ Group, into 3 core segments. One's the core bank, which is our branch-based banking and business banking, and that's mainly consumer-based lending. The national finance business will cover our equipment finance and our debtor finance, the recently acquired vendor finance business from CIT and the motor vehicle finance business, and then on top of that we've recently acquired an insurance business. So they're the three core elements of our business going forward. They all carry different risks. We're bankers. We're in the business of managing risk and pricing risk accordingly.
And I gather you've got a new product out for retail investors, a bit like the UK premium bond.
Yeah, look, we've got a new Save to Win product that's going to be launching in November, and it's a lottery-style product. It's obviously a regulated product, but for every $250 minimum balance, you get 250 entries in a monthly draw. Initially, that monthly draw will be for $30,000 and $20,000 for the first ticket out. So I'm sure it'll appeal to a lot of our existing customers, and I believe it'll appeal to other customers. And as you said, the product's used in the UK. A similar product's also in place in New Zealand. It's been very successful.
So don't put it on the horses, put it on you. David Liddy, thank you very much for talking to Lateline Business.
Thanks, Tikki. Nice to talk to you.